When the yield curve became inverted in late 2022, many people, us included, started talking about how such an event is usually a harbinger of recession. But to this point, we have not yet seen a recession. Still, the fact that the yield curve remains inverted is important, both for your investments and as an indicator of how bond investors feel about the future state of the U.S. economy. So what is a yield curve? It's a plot of the returns that are available on U.S. Treasury securities of different maturities. Normally, this curve is upward sloping, with longer-term Treasuries providing greater returns than shorter-term ones. This makes sense, because with longer-term Treasuries, it takes a longer time to recover the principal, which is usually riskier than the shorter time it takes to recover principal with short-term Treasuries. A flat yield curve, meanwhile, represents that a period of stable economic growth and inflation is expected. However, when a yield curve is inverted, as an investor you can earn more by buying shorter-term Treasuries than longer-term Treasuries. Normally, this is an indicator that a slowdown in the economy is coming. Still, when planning your long-term investment strategy, it's important not to get hung up on the fact that the yield curve is inverted. When the yield curve uninverts, you don't want to suffer any fallout from a decline in short-term rates. That's why you may want to consider a laddered approach in which a total investment is spread evenly across a desired time frame. As each portion matures, you can direct the proceeds into the asset class that fits best at that time. An investment professional can help you determine the long-term strategy that's best for you.